Most people think wealth is built by finding the right stock, or buying one property, or jumping on the latest crypto trend. But the wealthy know something different. Wealth isn't about betting on a single winner. It's about building a system that survives any market cycle. Think about it. 2008 crushed stock portfolios, but those holding gold thrived. 2020's pandemic shook real estate, but tech equities exploded. Inflation in 2022 eroded cash, but commodities like oil and wheat soared. Every cycle favors a different asset. And the rich? They're not surprised, because their wealth isn't sitting in one basket. It's spread, balanced, protected. That's what this video is about. The map of wealth, the complete guide to asset classes. So that you, whether you're just starting out or already investing, can understand where money hides, how it grows, and how to protect it from disappearing overnight. Welcome to the first lesson in true financial independence. Let's start with the foundation, the 5 pillars of wealth. Every investment in the world, from stocks to farmland to NFTs, falls into one of these categories. 1. Equities, stocks, and businesses. When you buy equities, you're not just buying shares. You're buying a piece of a company's future profits. Example: Apple stock is a slice of Apple Inc. itself. Equities thrive in growth cycles, when innovation, productivity, and consumer spending rise. Why the rich love equities? They offer the highest long-term returns of any asset class. Historically, U.S. equities have delivered 8–10% annualized returns. The risk? Volatility. Equities crash hard in recessions. That's why millionaires don't only hold stocks, they balance them too. Real estate, physical and REITs. Real estate is tangible wealth: land, homes, buildings. It creates money in 2 ways. 1. Appreciation, property value rising. 2. Cash flow, rent, lease income. Why the rich hold it? It's a hedge against inflation. It produces passive income. It builds generational wealth, assets that children inherit and still earn from. But real estate isn't risk-free. Illiquidity. You can't sell a building in 24 hours. Cycles. Bubbles form and burst, like 2008. Management headaches. That's why quiet millionaires diversify within real estate, across residential, commercial, and even REITs, real estate investment trusts. 3. Fixed income, bonds and debt instruments. This is the safety net asset. When you buy a bond, you're lending money to a government, a corporation, or a municipality in return for interest. Bonds aren't flashy, but they're essential. They provide stability when markets crash. They generate predictable income. They balance the volatility of equities. Example: during the 2008 financial crisis, U.S. Treasury bonds gained value while equities collapsed. Quiet millionaires use bonds like shock absorbers, not to get rich, but to stay rich. 4. Commodities: gold, silver, oil, agriculture. Commodities are raw materials, the backbone of economies. Gold and silver protect against inflation and uncertainty. Oil, tied to global growth and energy demand. Wheat, corn, soy, tied to food security. The wealthy use commodities as insurance. When currencies weaken, gold holds. When inflation rises, oil and metals climb. When geopolitics shake markets, commodities offer safety. Gold especially is the timeless hedge. For centuries, it has preserved wealth when everything else failed. 5. Alternative assets: crypto, private equity, collectibles, startups. This is the experimental basket. High risk, high reward. Bitcoin, Ethereum, and blockchain projects. Venture capital in startups. Collectibles, art, watches, rare cars. Why the rich play here? These assets offer asymmetrical returns. One success can outweigh many failures. They're uncorrelated. They don't always move with stocks or real estate. But here's the truth. Alternatives should never be your core. They're the spice, not the main dish. And in Chapter 2, we'll explore how these assets behave across market cycles, bull runs, recessions, inflations, and how the wealthy adjust their mix to stay ahead while everyone else panics. Now that you understand the 5 pillars of wealth, here's the truth most beginners miss. Assets don't move in isolation. They dance in rhythm with market cycles. And if you don't understand these cycles, you'll always feel like investing is chaos. But if you do, you'll see the patterns, the order in the apparent disorder, the 4 phases of a market cycle. Every market, stocks, real estate, commodities, moves through 4 repeating phases. 1. Expansion, economic growth, jobs rising, optimism, equities and real estate thrive. Commodities rise slowly as demand increases. 2. Peak, growth overheats, inflation rises, central banks raise interest rates. Commodities, especially oil and metals, often spike. Equities begin to wobble. 3. Contraction, recession, stocks crash, real estate stalls or declines. Bonds gain strength as investors flee to safety. Gold rises as fear dominates. 4. Recovery, interest rates cut. Equities bounce back. Real estate recovers slowly. Commodities stabilize. How each asset behaves in cycles. Equities, explosive in expansion, fragile in contraction. Real estate, slow-moving, peaks later, recovers later. Bonds, defensive, rise when everything else falls. Commodities, peak late in the cycle, thrive in inflation. Alternatives, highly unpredictable, but thrive on hype cycles. The wealthy know this. That's why they don't panic when stocks fall. They already hold bonds and gold. They don't chase property at the peak. They wait for downturns. They don't bet on crypto with their core money. They allocate a slice. Market cycles are like seasons. You don't curse winter. You wear a coat. You don't fear summer. You adjust your habits. The rich build portfolios that adapt, not break. In Chapter 3, we'll dive into how the wealthy actually allocate across these assets, not randomly, but with strategic frameworks like the All-Weather Portfolio and age-based allocation strategies. Now that you know the 5 pillars of wealth and how they behave in cycles, the next question is, how do the wealthy decide how much to put in each? The answer lies in allocation frameworks, proven systems that guide how portfolios are built, protected, and grown. Because the truth is, picking the right stock doesn't matter if your overall allocation is wrong. 1. The age and risk rule. Simple but powerful. The first principle is basic but effective. The younger you are, the more risk you can take. The older you are, the more safety you need. Rule of thumb: 100 minus your age equals percent in equities. Example: at age 30 to 70% equities, 30% bonds or others. At age 60 to 40% equities, 60% bonds or others. It's not perfect, but it forces discipline. It ensures you aren't 65 years old holding 90% in crypto. 2. The All-Weather Portfolio, Ray Dalio. One of the most famous allocation models is Ray Dalio's All-Weather Portfolio. It's designed to survive any economic season. 30% stocks, growth during expansions. 40% bonds, protection during recessions. 15% commodities, gold, hedge against inflation. 15% other diversifiers, inflation-protected bonds, alternatives, why it works, no single bet. Each asset class balances the others. Historical backtests show that while this portfolio doesn't deliver the highest returns, it rarely collapses. It's a fortress. 4. Core satellite model. This is a modern approach. Core, 70–80%, equals safe, diversified, boring, index funds, bonds, REITs. Satellite, 20–30%, equal sign, high conviction ideas, tech stocks, crypto, private equity. Think of the core as the earth, stable and grounding, and the satellites as exploration, exciting, but not essential for survival. 5. Real-life allocation of the wealthy. Research from Capgemini's World Wealth Report shows how millionaires allocate on average 25% equities, 25% real estate / 20% fixed income, 15% alternatives, 10–15% cash and commodities. Notice the balance. No 100% bets. No all-in on one shiny object. In Chapter 4, we'll bring this down to earth. You'll learn the step-by-step blueprint to start building your own diversified portfolio, no matter your income, age, or starting point. So far, you've learned the 5 pillars of wealth, how they behave in market cycles, the allocation frameworks the wealthy use. Now let's get tactical. Here's a blueprint to build your own diversified portfolio. Step by step. Step 1. Build your financial base. Before you invest, create your foundation. Emergency fund. 6 to 12 months of living expenses. Insurance, health, term life. Protect against shocks. Kill high-interest debt. Credit cards, personal loans. These bleed faster than any investment can grow. Without this base, investing is like building a skyscraper on sand. Step 2. Define your goals and risk profile. Ask yourself, what am I investing for? Retirement, home, wealth, freedom. What's my timeline? 5, 10, 30 years. How much risk can I tolerate without losing sleep? Example, a 25-year-old saving for retirement can lean 70–80% into equities. A 55-year-old nearing retirement should shift toward bonds, real estate, and cash flow assets. Your allocation should match your life stage. Step 3. Allocate. Across the 5 pillars, here's a sample starter blueprint. Not financial advice, just education. 50% equities via index funds or ETFs for global diversification. 20% real estate, direct property, or REITs. 15% bonds, fixed income, stability and income. 10% commodities, gold, silver, insurance against inflation. 5% alternatives, crypto, startups, high risk, high upside. This is balanced, diversified, and adaptive. Step 4. Rebalance annually. Markets move. Your portfolio shifts. If equities boom and become 70% of your portfolio, sell a slice, move into bonds or real estate. If commodities crash, buy a little more at low prices. Quiet millionaires rebalance at least once a year, like trimming a garden to keep it healthy. Step 5. Automate and stay consistent. The hardest part of wealth building isn't knowledge, it's consistency. Automate monthly investments, SIPs, DCA into ETFs, REIT contributions. Remove emotions from the process. Trust compounding. Remember, wealth isn't built in weeks, it's built in decades. The rich don't gamble, they engineer. And now you have the same toolkit. In Chapter 5, the final chapter, we'll connect it all together. How to think like an asset researcher. not just an investor, so you can evaluate opportunities across any market. We've covered the map. You now know the 5 asset classes, how they behave in market cycles, how the wealthy allocate strategically, and the blueprint to build your own portfolio. But here's the ultimate shift. The difference between the average investor and the wealthy is not just allocation, it's research. Quiet millionaires don't just buy assets, they study them. The mindset of an asset researcher. An investor asks, is this going up or down? An asset researcher asks, what is the intrinsic value here across time? They analyze businesses, balance sheets, moats, leadership, cash flow. Real estate, location trends, rental yields, infrastructure growth, bonds, credit risk, interest rate cycles, commodities, global demand, geopolitics, inflation cycles, alternatives, technology adoption, regulatory risk, asymmetric potential. Instead of gambling on hype, they investigate fundamentals. And that's why their wealth lasts. How to train. As an asset researcher, 1. Read reports, not headlines. Annual reports, government filings, real estate studies, IMF outlooks. 2. Follow cycles, not noise. Study past booms and busts. History is a mirror. 3. Compare risk versus reward, not just returns. A flashy 20% return means nothing if it collapses tomorrow. 4. Think like a detective. Always ask, who benefits? Who pays? What's the long-term trend? 5. Diversify your lens. Don't only research equities, research all assets. That's how you see opportunities others miss. We live in a world of chaos. AI disrupting industries, inflation eroding savings, global uncertainty. Most people will either panic or blindly follow trends. But the asset researcher, they'll see through the fog. They'll adapt. They'll thrive. Because while everyone else is chasing hype, the researcher is building fortresses of wealth. This was just the beginning. If you've stayed till now, you're not just a viewer. You're part of a movement. People who value substance over vanity. Here's what to do next. Subscribe. I'm building a free library of masterclasses on equities, real estate, bonds, commodities, and alternatives. Comment. Tell me which asset class you want me to break down first in detail. Share. Send this to a friend who's stuck chasing hype so they can start learning the real game. Because in this world, wealth that whispers outlives wealth that shouts. And your journey to becoming an asset researcher starts right now.